In 89 days, just 89 days, the American stock market lost half its value. Not slowly, not quietly. $30 billion wiped out. That's $550 billion in today's money, gone. And the worst part? Almost nobody saw it coming. In fact, the smartest people in the room said the exact opposite was true. Here's why this matters. Right now, every generation thinks their bull market is different. Every generation thinks they finally figured it out. And every generation eventually learns the same brutal lesson. The 1929 crash didn't just destroy portfolios. It destroyed entire belief systems about how markets work. It changed the way governments regulate money. It reshaped the global economy for 2 decades. And the conditions that caused it, they're not ancient history. They're a checklist. And some of those boxes, they're getting ticked today. So in this video, we're going to break down exactly what happened in 1929. The mechanics, the psychology, the decisions that turned a correction into a catastrophe. And the one insight that almost no one talks about, the thing that actually started the crash before Black Tuesday even happened. Let's get into it. To understand the crash, you have to understand the high. The 1920s were the original everything bubble. The US economy was on fire. Industrial output doubled. New technology, cars, radios, electricity, was changing daily life. And the stock market? The Dow Jones went from 63 points in 1921 to 381 points by September 1929. That's a 500% gain in 8 years. People who'd never owned a stock in their life were suddenly investors. Factory workers, farmers, housewives, everyone wanted a piece. And Wall Street made it easy. Here's the thing that most history classes skip over. Margin trading. You could buy $100 worth of stock with just $10 down. The broker loaned you the rest. If the stock went up, great. If it went down, the broker called you to pay up immediately. That's called a margin call. By 1929, roughly 40% of the cost of stocks was being funded by borrowed money. Borrowed money. The whole market was a leveraged bet. And leverage is just fine until it isn't. Think of it this way. You buy a house for $100,000. You put down $10,000. The house drops to $85,000. You've lost 150% of your actual cash. That's what margin does. It turns a 15% decline into a total wipeout. Now multiply that across millions of investors. Across the entire economy, that's what 1929 was. The crash didn't start on Black Thursday, October 24th. Most people think it did. It didn't. The crack started in the summer. August and September 1929, the market started showing instability. Small drops, rebounds, then more drops. The smart money, the institutional players, was quietly getting out. On September 3rd, 1929, the Dow hit its all-time high of 381.17. That was the peak. Nobody rang a bell, nobody sent a memo, then it started sliding. Meanwhile, there were real economic warning signs that the bulls were ignoring. Steel production was down, car sales were slowing, agricultural prices had been depressed for years. Farmers were already in a depression before Wall Street even hiked a sweat. Consumer debt was at record levels, and yet the Harvard Economic Society, the top economists in the country, published a report in October 1929 saying, and I quote, "A serious depression seems improbable." That report landed 1 week before the market collapsed. October 24th, 1929, Black Thursday, the market opens. Within the first hour, panic selling starts. The ticker tape, like the machine that prints stock prices, falls 2 hours behind. Investors across the country are watching prices from 2 hours ago. They have no idea how bad it really is. Nearly 13 million shares trade in a single day. That's almost double the daily average. Here's where it gets interesting. A group of leading bankers, JP Morgan's bank, National City Bank, pulled $240 million together and started buying stocks to stabilize the market. It worked. Temporarily, the market recovered by the close. People went home that night thinking the worst was over. It wasn't. Monday, October 28th, the Dow drops 13% in a single day. That is still one of the worst single-day drops in American history. Tuesday, October 29th, Black Tuesday, 16.4 million shares traded. The Dow falls another 12%. The ticker tape doesn't catch up until 7:45 that evening, 4 hours after the market closed. By the time it was over, $14 billion in market value was erased in a single day. In 1929 dollars. And here's the brutal mathematics of loss. If you lose 50%, you need a 100% gain just to break even. The market didn't recover to its 1929 highs until 1954, 25 years later. Think about that. If you were 30 years old in 1929, you were 55 before your portfolio recovered. Your entire prime earning years, gone. The crash didn't have to become the Great Depression. That part is important. Markets crash, they recover. That's what they do. The crash became a decade-long depression because of what happened next. Mistake number one, The banks collapsed. Banks had invested depositors' money in the stock market. When stocks crashed, banks didn't have the cash to pay people back. Between 1930 and 1933, over 9,000 banks failed. People lost their entire life savings, not just their investments, their savings. There was no FDIC insurance. It didn't exist yet. Mistake number 2, the Federal Reserve tightened credit. Instead of pumping money into the economy, the Fed raised interest rates in 1931. They were trying to protect the gold standard. But what they actually did was strangle what little economic activity remained. Mistake number 3, the Smoot-Hawley tariff. Congress passed massive trade tariffs in 1930. The idea was to protect American jobs. Instead, other countries retaliated. Global trade collapsed by 66% between 1929 and 1934. The whole world went down. 3 catastrophic policy decisions turned a market crash into a decade of 25% unemployment, mass poverty, and worldwide economic devastation. The market crashed. The government made it a depression. Here's the angle you won't hear on most finance channels. Everyone focuses on the crash, the drama of Black Tuesday, the panic, the margin calls. That's the movie version. But the real lesson of 1929 isn't about what happened in October. It's about what happened in the years before. Specifically, how ordinary people were systematically set up to fail. In the 1920s, companies could, and did, issue stock with almost zero transparency. No audited financials, no mandatory disclosures. You were literally buying a number on a piece of paper and hoping the person selling it to you was telling the truth. Brokers encouraged maximum leverage because they earned commissions on every trade. The more you borrowed, the more you traded, the more they made. Their incentive was your risk. And the government? Completely hands-off. No SEC, no regulations. It was the Wild West with a ticker tape machine. Sound familiar? Because the 1920s had a version of everything we have today. Leveraged products marketed to retail investors, platforms that profit from trading volume, assets with opaque fundamentals but viral momentum, and a chorus of experts saying the good times will last forever. The crash of 1929 didn't happen because markets are inherently evil. It happened because the infrastructure of protection didn't exist yet. Today it does. The SEC, the FDIC, circuit breakers on exchanges, central bank intervention playbooks. The system is better. It is not foolproof. And the psychological conditions, greed, leverage, and the belief that this time is different, those haven't changed at all. Here's the one-sentence takeaway. The 1929 crash was not caused by a single bad day. It was caused by years of borrowed money, zero transparency, and the universal human belief that the market only goes up. The investors who survived and thrived in the decades after 1929 weren't geniuses. They were simply the ones who had no margin debt, owned quality assets, and didn't panic sell at the bottom. That strategy wasn't complicated then. It's not complicated now. Know what you own. Don't borrow to invest. Have a plan for when things go wrong, because they will. They always do. If this video made you think differently about how markets work, hit that like button. It helps more people find this content. And if you want to know how the investors who actually made money during the Great Depression did it, that video is right here. We go deep on the exact strategies that built generational wealth while everyone else was panicking. Subscribe if you haven't. New video every week. I'll see you in the next one.